maybe this was a planned action because the liquidity was thin and they wanted to shut down COMEX so people couldn't stand for delivery. And I don't really believe any of this stuff. I mean, it could be true, but there's a larger point here. And the point I want to make is that this doesn't really matter because at one point, at some point, there's going to be an oopsie at the COMEX and it's going to stop working because gold is going to go into a backwardation. And that means that all commodity exchanges are going to go down because the dollar isn't going to work anymore. And then gold is going to become the money, and then all other commodities are going to be denominated in gold and silver terms.
Veteran market analyst Rafi Farber warns that the global commodities system may be on the brink of a major shift, with gold and silver poised to reclaim their role as money. Farber explains that recent disruptions at the COMEX could be part of a planned action, taking advantage of thin liquidity to prevent investors from standing for physical delivery. While such events may cause short-term uncertainty, Farber emphasizes that the larger systemic point is unavoidable. At some point, the current system may fail. He predicts that gold could flow into Asian markets, creating backwardation that undermines the functionality of commodity exchanges and the dollar as the global reserve currency. When this occurs, Farber suggests that gold will emerge as the ultimate form of money, with all other commodities potentially being denominated in gold and silver. This potential shift highlights the importance of understanding physical precious metals, their role in global finance, and the impact on commodities and currencies. As markets evolve and systemic risks grow, investors may find themselves needing to rethink traditional approaches to wealth preservation. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
At one point, it is going to go down. Now, what you don't want to do is get sucked into a narrative that says this is the point where it's going down, and that's why you have to go all in on gold and silver right now. Never go all in on gold and silver. You always have to have some amount of dollar liquidity, even as we get to the end game, because you never know what exactly is going to trigger, and you don't want to be in a situation where you have $0 to deal with whatever you need to pay for in the immediate sense. So, while all these narratives are fun to speculate on, and whether there's a planned action or a planned subterfuge or a sabotage of the CME because they didn't want to stand for delivery, there's not much worth or value in buying into all of these theories, even if they are true. Because what you have to do is you got to keep stacking, and you've got to keep a certain amount of liquidity up to and through the end game. And once the end game hits, then we can see in retrospect what exactly it was that caused all the ruckus in approximate cause sense. But until then, it doesn't really matter. Don't get sucked into any narrative. Just keep stacking calmly and rationally, and you will get through it, and so will I. But anyway, we're going to go into some evidence on what is happening in gold and silver. There is a short squeeze going on. I will show you mathematically how it's happening and who are the victims of this. And also we're going to talk about palladium, which looks like it's having another record delivery month. So on the latest silver move, up to $57, we have here the junk silver premiums have hit zero. I think the feed for this data is from Monex or Monex, or however it's pronounced. I think that's where they get it from. You can see here that the premium on junk silver coins, which I think is the most appropriate form of silver because it's the most recognizable in the smallest denominations at the smallest premium. That's 0.04%, essentially zero. You can get junk silver, physical silver coins for the same as spot right now. So this is a pretty good deal. Anyway, we're going to go to the next slide here. London spot silver premium returns. Yes, silver went up to $57 yesterday or on Friday, on Black Friday, on low liquidity and low volume. So we have here, this is the silver futures spot silver spread. When it's negative, that means there is a premium for New York silver over London spot. Some people call this backwardation. I don't call it backwardation. I just call it a premium on New York. But whatever you call it, it's happening again. You can see this was the record premium in New York in October when silver hit about 54, 55. That was, everyone was freaking out about that. And we got rid of the premium. This is the normal state of the market. This is a sort of a kind of a backwardation, but not really a backwardation. The New York premium or the London discount on London spot silver has now reappeared. It's at 0.3%. It was down to 1% as of 2 days ago, or I think that was Wednesday, right, the day before Thanksgiving. So the conditions that led to silver flooding into London from New York have reasserted themselves. Let's go to the next slide here. Can see here why this is probably the bottom in gold, and by extension silver is already in. It's not going to help you much with silver because we're at new all-time highs, but we're not yet in gold. We're at 4250. I think the all-time high was close to 4500. But we see here the interaction between the price and open interest here. Every time we have hit this level of open interest or near it, we have hit a bottom in gold. You can see here, this is when we were back down to about 400,000 contracts in March of 2024. This was a bottom in silver prices. It took price a few weeks to move from here, but it didn't go any lower than this. Same thing here. We hit about 400,000 in June, July 2024. Again, we see a local low in gold here, and from here it went up. We see it again over here. This one took longer, but price did not move substantially lower than this area. It was between about 3,500 and 3,200, 3,300. It was bouncing around very tightly, not because of, but in correlation with open interest, the amount of contracts open on the New York futures market. It was around this number, and price did not go substantially below here. So now we are at 420,000, I think. This is on day old. This says 432,199, but we are at about 420,000 now because of deliveries that have been made in the last few days, and that closes open interest, that closes contracts. So you can see here is a bottom. I don't think we're going to go below 4,000, maybe never, maybe only once in the final crunch. I don't know. But even if we do, it's not going to be for a very long period, so I wouldn't even try to time it at all. This is very likely a bottom here in gold, and we can see that from the open interest, and it's going to be the same pattern here. I don't know that for sure. I could be wrong, but I'm just going after the last three instances of when this happened. When we hit this level in open interest, we're hitting it again. I think we are at or close to a bottom in gold that has already been hit. Now we're going to go to the next chart here, and this is where we see the short squeeze. It's not an incredible or spectacular short squeeze, but mechanically that is what's happening. How do we know this? Because since the middle of November, right, we see here that open interest, I drew the line here, was about 480,000 contracts. Now we are down to 420. That's 60,000 contracts down, closed out. And in that time period, we went up from $4,000 to $4,250. So contracts are closing out and price is going up. That means that shorts are closing at higher prices. That is the definition of a squeeze, and that's what it is. That's what's going on right now.
Market analyst Rafi Farber explains why investors should remain strategic in gold and silver, avoiding narratives that urge going all in during market fluctuations. While speculation about planned actions or disruptions at the CME may be intriguing, the key is maintaining a balance between stacking precious metals and holding enough dollar liquidity. This ensures readiness for unexpected market triggers during what may be the market's endgame. The analyst highlights a current short squeeze in silver, with junk silver premiums dropping to nearly zero, allowing investors to acquire physical coins at spot prices. Observing New York and London spot silver spreads, the market shows the reappearance of premiums on London silver, indicating that previous conditions affecting silver flows are reasserting themselves. Turning to gold, open interest in futures contracts suggests a potential bottom, with historical patterns showing stabilization when contracts reach current levels. Recent data from November demonstrates a decrease from 480,000 to 420,000 open contracts, coinciding with a rise in gold prices from $4,000 to $4,250. This indicates that shorts are closing at higher prices, confirming a mechanical short squeeze in progress. These insights provide a data-driven perspective for investors seeking to understand price mechanics in precious metals, emphasizing measured, rational stacking over speculation. Let's get into the interview.
Now we are at 458, over here 458 million. From the beginning, from the huge London spot premium, we were at 532 million. Now we're at 458. That's about 80 million something contracts, not contracts, 80 million ounces of silver have been drained from New York. Most of it probably going to London, though probably not all of it. Some of it might be going to Shanghai. We'll see when we have those numbers. The Shanghai silver stocks, by the way, are at 10-year lows at 520 tons. This is actually 10-year lows. So we see here 520 tons. What is going to cause silver to flood back in? There's going to have to be a Chinese or a Shanghai premium on silver. We'll see if they can get that, or maybe there's going to be problems in Shanghai. Who knows? The exchanges are under stress. Maybe the cooling incident had something to do with it. Now we're going to go to palladium. There is some exciting stuff going on in palladium right now. Here we see this is from 2 days ago. There is 557 contracts left in the December contract on the last day of this contract as a futures contract before it goes to delivery. So there's going to be at least 557 deliveries of palladium. And there's probably going to be more if there's going to be spot buys, which there always are a few of in the month. You can see here on the bottom, this is from November 17th, 2020. This is the yearly deliveries. And we see here, this is palladium. So this is the record all-time deliveries. You can see here 570 contracts. So we're probably going to break that this month. It's going to be at least 557. It's probably going to be more than that. We'll go to the next slide. Has to do with gold stocks. This is the gold to Huey ratio. The higher this is, the cheaper gold stocks are in terms of gold. The lower it is, the better gold stocks are performing in terms of gold ounces. So we see here we have re-hit a major trend line that has been in place since 2016. This is the all-time bear market low in gold stocks in the end of 2015. This is the 2020 crash. And here is the bottom trend line. It was hit in 2016. It was hit again in 2020 during that gold bull run.
Market analyst Rafi Farber breaks down recent movements in silver, palladium, and gold stocks, highlighting key trends and market mechanics. Silver has experienced a significant drain from New York, dropping from 532 million to 458 million ounces, likely moving to London or possibly Shanghai. With Shanghai silver stocks at a 10-year low of 520 tons, the potential for a premium-driven return remains uncertain, signaling continued pressure and tightness in the physical silver market. Turning to palladium, the analyst points to record deliveries, with at least 557 December contracts scheduled for delivery. This level is on track to surpass previous yearly records, highlighting the tight supply and strong demand for palladium. Gold stocks also show important signals, with the gold to Huey ratio re-hitting a major trend line in place since 2016. Historical patterns suggest that lows in this ratio often precede strong performance in gold equities, providing insight into potential buying opportunities. These developments demonstrate the importance of monitoring both physical metals and related equities to understand broader market trends. Strategic positioning and awareness of supply-demand dynamics are critical as precious metals continue to respond to market pressures and record deliveries. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on it. Appreciate you for tuning in.